Well, hello, and welcome back to Accounting 202. I'm your host, Dr. B, Principles of Accounting 2. Today we're going to be talking about variable costing. We've talked a lot about variable costing in previous chapters. We've talked a lot about it as it relates to manufacturing, which is what this course focuses on. We will continue our discussion on variable costing. Before we start, I'd like to touch on a couple of key things. Quick housekeeping notes. You should have completed the Chapter 20 homework assignment this past Sunday, yesterday. If you did not complete that this past Sunday, please get it in as soon as you can. There was a small error with the due date in Cengage, so I apologize for that. However, you should have been following the script as it's written in Blackboard. So if you have anything that's past due, it is critical that you get all of that in by this coming Sunday. Reason for that is you have your midterm exam next week. Oh, midterm exam. Yeah, midterm exam next week. Next week is midterm week. We are pretty much at the end of February, which means first week of March is midterm week. The midterm exam for this course is due by March 7th. It is currently open and available, so if you want to work ahead, you're more than welcome to. You might be asking, Dr. B, what is on the midterm exam? It covers chapters 15 through 21. So everything basically weeks 1 through 7. Weeks 1 through 7 will be found on the midterm exam. So that's, what is that, 15 through 21, right? Or 16 through 21? Yeah, so it's the first 7 chapters of this part of the book. So everything from weeks 1 through 7 will be covered on the midterm exam. The midterm exam is worth 10, is it 10% or 20%? Ooh, good question. I forget. It might be 20% actually. Let's just double check. It's 10 questions. Each question is worth 1 point each, and it's worth 10 points. So it's 10% of your total grade is on the midterm exam. So my recommendation to you in terms of prepping for the midterm exam, review your homework and quizzes from weeks 1 through 7. Take your time on the midterm exam. It is not timed. It is open book. It is open book and it is open note. So I strongly, strongly recommend that you take your time on the midterm exam answering those 10 questions. The final exam is due not this coming Sunday, but the following week on the 7th. Is when the midterm exam is due. I think that's on a Friday. Is that right?
The 7th. I think the 7th is on a Sunday.
Is it the Sunday or Friday? Let's see.
Yeah, it's
It's on a
Sunday.
Sunday. You're good. Okay, it's on a Sunday. So yeah, that's where we're at.
Are we able to
Go ahead.
open up our homeworks and quizzes even after they've been graded and the due date is passed? We're
Yes.
able to go back and look at
Yes,
it?
absolutely. Yep.
Okay.
Great question, Thaddeus. So the way it works is you are able to revisit past homeworks and quizzes even after the due date. Those are still open. Okay. So you're more than welcome to revisit those. I did mention this before, and I'll mention it again. If you are not happy with a grade that you received on any of the homework assignments, you can retake those unlimited number of times. Okay? You'll always receive the highest grade from the homework assignments. So if you decide to retake a homework assignment from week one or two, whenever that was, and you're like, oh, I didn't do well. I got a 3 out of 5. Please retake it. Try to get 5 out of 5. It can only help you, right? As I mentioned before, with accounting, we learn by doing. It's a continuous process. It's a practice, right? Accounting is a practice. So what do? We learn by doing. So I strongly recommend that you retake a homework assignment that you're not satisfied with, or even if you are satisfied with it and you just want to kind of relearn that information, please do it again. Absolutely, it can only help. With respect to quizzes, previous quizzes that you've taken, like the one you took in week 5. If you're like, Dr. B, I'm not happy with my quiz grade, quizzes can be taken up to 2 times. Okay, so please feel free to retake it if you haven't already attempted the 2 times. I strongly recommend that you look at those results also. The midterm exam can only be taken 1 time. Okay, it's a midterm exam, right? So midterm and final can only be done 1 time. Midterm is worth 10% of your grade. So open book, open note, yes, yes. Take your time. It is open and available if you want to start it now. Remember, do the save and close. Don't do save and submit. Only submit when you're ready, right? So yes, please go ahead and take a look at that.
Thank you so much. That's excellent news. Thank you
Does
so
that
much,
help,
Dr. B.
Angela? I know it does.
Yeah.
I know it does. Absolutely. Yeah, so Angela, you go ahead and get that highest grade possible. I know you will. Okay, so take your
Yes,
time.
sir. Thank you.
All right, my pleasure. Okay, so those are my housekeeping announcements. Let's go ahead and jump into the content for this week. Variable costing for management analysis. Now, some of you are probably using the previous version of the book, so this might be chapter 20, I think. So it's all the content's the same. The only difference is the textbook publisher, they made a few minor changes, and so this version is a little bit longer in terms of number of chapters, but I promise you it's all the same content. Okay. Oh, before, and Angela, you just reminded me of something. If you're ever like, oh, I want to go back and watch some of our previous sessions. You're like, oh, I wish we could go back and watch a previous session. You can. So if you go to the announcements area and you go ahead and select one of those recordings, right, from previous recordings, you can play those. Hello and welcome to chapter 19. Right? So, but here's the other good thing is it's on YouTube. So if you're like, oh, I want to go and watch the rest of them, go ahead and click on that image in the top left corner. It'll take you to my YouTube page. All of our sessions have been recorded and posted here on YouTube, Dr. B's lectures page. So please feel free to subscribe. Hit that like button. I'm kidding. I'm not one of those YouTube people. But all of the videos are here. So if you're like, oh, I want to go back and watch it, I can understand those concepts, all I do is click on the respective course, Principles of Accounting 2, and all of the lectures are here. So please feel free to watch those, yeah? Hopefully that'll also help. So thanks, Angela, for the reminder. I want to make sure that
Thank you, sir.
that was it. I appreciate that. Okay, so let's go ahead and jump in, shall we? Andre, do you have a question?
Yeah, thank you, Professor. Where could I find those the videos again for the
Yep. So if
YouTube? So it's on YouTube, but it's the tab.
yeah, so if you go to the announcements and you click on the image in the top left, it should open my YouTube channel. Go ahead and come down and just click on Dr. B Lectures, and then click on the respective course. So this course is Principles of Accounting 2. Just click on that, and it opens up every video I posted. That anything that's related to Principles of Accounting 2 content is here. So please feel free to go through. You'll see that it's titled. The chapter numbers might be a little different, but you'll see, but based off of the title, what topic it covers. Andre, does that help?
It helps, but I noticed that when I press announcements on my end, it gives me like a notification what you're talking about so far.
Got it. I just put it in the chat for you.
Got it.
Cool.
Appreciate it. Thank you.
Hey, my pleasure.
Professor, can we also find the recordings on Blackboard? Like if you go to Collaborate Ultra, it'll say recording, class
No,
recording.
it won't because we don't use Collaborate Ultra. We use WebEx.
Oh, okay.
Yeah, so it's not. You won't find anything there. It'll all be empty. Um, I wish that WebEx had an area where it had like a list of all the recordings, but it doesn't. So what I'll do is and Thedrona, thank you for bringing that up. What I'll do is I will create I'll just send out the link to the YouTube page where all the videos are. That's probably the
That's
easiest way.
fine.
Yeah,
Thank you.
absolutely. Thank you. Cool. Okay, so let's rock and roll, shall we? Let's talk about variable costing. Yay! For management analysis. All right, variable costing. What is it? So we talked about variable costing before. We know that variable costing, as it relates to manufacturing, includes direct labor, direct materials, and factory overhead. The reason why direct labor, direct materials, and factory overhead are considered to be variable costing is because the cost changes with each level of output. Meaning, I create one additional unit. I create one additional calculator. Okay, I manufacture calculators. If I create one additional calculator, that means that I've used more direct materials, more direct labor, and more factory overhead to create this additional unit of output. That's why we say direct materials, direct labor, and factory overhead are considered to be variable costs in production. Within though, or looking at those variable costs, there are a couple of ways to analyze those costs. One of them is through this concept called absorption costing. Absorption costing. And within absorption costing, we take direct materials, direct labor, and factory overhead, and we include those in the financial statements through cost of goods sold. We'll talk about it. So in absorption costing, we identify our cost of goods sold, which includes the direct materials, direct labor, and factory overhead. And you'll see here that we have our sales, that's our revenue, okay? Sales is revenue, minus cost of goods sold equals gross profit, minus selling and administrative expenses equals operating income. The reason why we see selling and administrative expenses just below gross profit is because selling and administrative expenses are identified as a variable cost. Selling and administrative expenses are directly related to the selling of our products. That's why we see it there. So, as a manager, as managers, we need to identify our variable costs. These are also called direct costs. They include direct materials, direct labor, and variable factory overhead. Variable costing, fixed factory overhead costs are not a part of the cost of goods manufactured. Okay. Here's how it works. Direct materials, direct labor, variable factory overhead. Variable factory overhead comes from things like electricity that is used in the manufacturing process. Indirect materials is also a part of variable factory overhead. Indirect materials are small components that make up the product, that don't make up the larger cost. Variable factory overhead also includes indirect wages, which would be things like maintenance. We do not include direct or fixed factory overhead in our variable cost. Fixed factory overhead would include things like factory rent, office salaries. Those are fixed components of overhead that do not change over time. We do not consider those types of things when we identify variable cost. Here's a nice comparison of absorption cost and variable cost. Here's the difference, and this is why it's important. I want you to think of absorption costing and variable costing as two different costing methods that managers use when we calculate total cost. Under absorption costing, you see that absorption costing includes the fixed factory overhead. It includes the fixed factory overhead. Whereas variable costing does not. Variable costing lists fixed factory overhead as an expense, not as a part of cost of goods sold, cost of goods manufactured. So under the variable costing method, we see it's broken out as we talked. The fixed components are broken out. We have our sales, which is our revenue, minus variable cost of goods sold. See how it says variable cost of goods sold, not just cost of goods sold. The reason why it's variable cost of goods sold is because we do not include the fixed parts of factory overhead. So sales minus variable cost of goods sold equals manufacturing margin minus variable selling administrative expenses. Not all selling administrative expenses, but variable selling administrative expenses. Here's the difference. Variable selling administrative expenses are expenses that we can directly tie to the selling of those products. Okay? It would include things like sales salaries, advertising for those particular units sold, which are different than sales salaries that for like sales managers, right? So there's that level of separation. So remember, variable selling administrative expenses are the expenses that we can tie to the selling of that product. So from a reporting perspective, we have our sales minus variable cost of goods sold equals manufacturing margin minus variable selling administrative expenses equals contribution margin. Don't worry, we'll break it out. Contribution margin is the axis of manufacturing over variable selling administrative expenses. So in other words, you take your manufacturing margin minus variable selling administrative expenses. What is manufacturing margin? Manufacturing margin is sales minus variable cost of goods sold. The word margin in a general sense means, it basically means profit. Margin means profit. It's essentially what margin is. Margin is a form of profit. The difference here is that we're breaking it out. So sales minus variable cost of goods sold equals manufacturing margin. You can also think of it as manufacturing profit. Minus the variable selling administrative expenses equals contribution margin. Contribution margin is sales minus your variable expenses. Then we have fixed costs. Fixed costs are broken out separately. They're not a part of the cost of goods sold. Fixed costs include fixed manufacturing costs and fixed selling administrative expenses. Fixed manufacturing costs would include things like depreciation expense for the machinery, the allocation of rent for that space, So one idea, one part of it. Manufacturing supervisor salaries. Those are fixed manufacturing costs. Fixed. Remember, fixed means it doesn't change over time. Fixed selling and administrative expenses, also part of fixed costs. These would be like sales supervisor salaries, large or corporate-wide advertising expenses, office expenses. Those will be fixed selling and administrative expenses. You add up your fixed manufacturing costs plus your fixed selling and administrative expenses to get to total cost. You take your contribution margin minus total fixed cost equals operating income. Any questions? Well, we're good with variable cost. Good so far? Okay. All right. Here's an example. You know how we like examples. It's good to work through examples so we better understand the information. So we have a company here, Martinez Company, manufactures 15,000 units, sold at $50 per unit. Here are the related costs and expenses for the company. Okay, so we manufactured and sold 15,000 units. Unit cost variable for manufacturing looks like it was what, $25 times 15,000, that's 375,000. Our fixed cost per unit is $10. $10 times 15,000 is 150,000. You add your variable, you add all your manufacturing costs to get to 525,000. Then we have $5 per unit of selling administrative expenses variable. So you take your $5 times the 15,000 units, that's 75,000. We have fixed selling administrative expenses of 50,000 to give us a total selling administrative expenses 125,000. Okay. So looking at the next slide, our selling price was $50 per unit. We sold 15,000, 750,000, minus a cost of goods sold of 525,000. How we got that? Remember, we had $25 per unit variable, $10 per unit fixed. That's $35. 25 plus 10, 35. $35 times the 15,000 units that we sold is 525,000. Sales minus cost of goods sold equals gross profit, 225,000. Minus selling administrative expenses. We had variable selling administrative expenses of 75,000. How we got the 75,000? $5 per unit variable expense for selling administrative times the number of units. So 75,000 plus fixed 50,000 selling administrative expenses. So 75,000 plus the 50 is 125. Gross profit minus 125,000 of selling administrative expenses equals $100,000 of operating income. This is the absorption costing. Remember, with absorption costing, we absorb the fixed and variable cost of goods sold and fixed and variable selling administrative expenses together. That's we're absorbing it. Absorbing fixed and variable together. When you hear the word absorption, think like a sponge. It absorbs all the costs. Instead of expensing them out, it absorbs them. What if we did variable costing? This is variable costing now. The slide below shows you absorption. This is variable. You're going to see a couple of key differences here. We still have our sales, 750,000, $50 per unit times 15,000 units sold, minus variable cost of goods sold. Remember, the variable cost of goods sold per unit was $25. We sold 15,000 units. That's 375,000. So 750,000 minus the variable cost of goods sold is 375,000 equals a manufacturing margin of 375. 750 minus 375 equals 375. Minus variable selling administrative expenses. That's $5 per unit, 15,000 of variable selling administrative expense equals 75,000. We take our 375,000, that's our manufacturing margin, minus our variable selling administrative expenses equals a contribution margin of 300,000. Then we subtract out our fixed costs. We have fixed manufacturing costs of 150,000. How did we get 150,000 of fixed manufacturing costs? So if we look back, the fixed manufacturing cost of 150,000 came from a fixed cost of $10 per unit times the number of units sold. So $10 per unit times 15,000 units equals 150,000. So 150,000 of fixed manufacturing cost plus fixed selling administrative expenses of 50,000. Remember, that was given to you. Equals 200,000 total fixed costs. We take our contribution margin of 300,000 minus our total fixed costs equals $100,000 of operating income. You see here that the two methods, while different from a reporting perspective, they yield the same operating income. The operating income will be the same for both methods. Whether you use absorption costing method or variable costing method, you will yield the same operating income. Remember, the primary difference here is with absorption, we have variable and fixed costs together. With variable costing, we identify the variable costs in the cost of goods sold, and we identify the fixed costs as expenses. That's the primary difference between the two methods. Any questions so far, or does it make a whole lot of sense? Really? We're good.
So far from me, Professor.
Good so far. Thanks to the drone. Appreciate it. Chandler, I saw you recently joined. I just want to make sure that you're good so far.
Yes, I'm good so far.
Wonderful. Thank you so much. Appreciate that. Excellent, excellent. So those are the primary differences between variable costing and absorption costing. Now let's talk about the effect on inventory. The effect on inventory. When the units manufactured equal the units sold, there is no change in inventory. That makes sense. When the units manufactured are greater than the units sold, there's an increase in inventory. Well, that makes sense because if I made more than what I sold, that means I'm going to have more sitting in finished goods inventory, right? Then if the units manufactured are less than the units sold, that means I have a decrease in total inventory. My finished goods inventory will be less because I sold more than I actually made. That's graphical representation. When the number of units manufactured are equal to the number of units sold, the operating income will be the same under both the absorption costing and variable costing methods. When the units manufactured are greater than the units sold, the variable costing method will be less than the absorption costing method. Okay. In our example, let's assume that only 12,000 of the 15,000 units were sold. If I only sold 12,000 out of the 15,000 units, my sales will be 600,000. I sold 12,000 units at $50 per unit. My variable cost would be 375,000. How we got that? We still made the 15,000 units, but we only sold 12,000. So we still need to account for the number of units manufactured, which is different than units sold. Manufactured, how many units I made. Sold, how many units I sold. Okay? So variable cost of goods manufactured is $375,000. $25 per unit of variable cost times 15,000 units. Remember, it's 15,000 units because that's how many I made, I manufactured, which is different than the number of units sold. Then I'm going to have ending inventory, right? Because I made 15,000 units. I only sold 12,000. That will give me an ending inventory of 3,000 units, which means I'll have an ending inventory for variable cost of 75,000. Variable cost per unit times the ending inventory. Variable cost per unit times ending inventory equals 75,000 in this example. So I take my variable cost of goods manufactured minus my ending inventory equals the total variable cost of goods sold. The key here is to separate the word manufactured from sold. It's very important that you remember the difference between cost of goods manufactured and cost of goods sold. Manufactured, in some cases, will be different than the amount you sold. And so, in this case, we take our sales minus total variable cost of goods sold equals our manufacturing margin of 300,000 minus variable selling administrative expenses. You see here at 60,000, it's based off of the amount that I sold. Selling and administrative expenses are accounted for the units that we sell. We sold 12,000 units. So we sold 12,000 units times $5 selling administrative expenses per unit that we sold. Yeah? Equals 240,000 gross contribution margin. Minus our fixed costs. Remember, fixed costs do not change regardless of the level of output. Fixed costs will still be fixed. 150,000 fixed manufacturing costs plus 50,000 selling administrative expenses that are fixed equals total fixed cost 200,000. 240,000 contribution margin minus 200,000 fixed costs equals operating income of 40,000. Okay. Now we see that it's less than the absorption costing method. The reason being is because I have a higher level of inventory. I made more than I sold. When that happens, our absorption costing will be greater than our variable cost. Under the absorption costing method, sales is the same, cost of goods sold is different. We manufactured 15,000 units at $35 per unit. Remember, under absorption costing, we take both the variable and the fixed cost together. That's why we're absorbing them together, variable and fixed cost together. So that gives me $525,000 worth of cost of goods manufactured minus ending inventory of $105,000. You'll notice the ending inventory amounts are different because under the absorption cost, we have $35 instead of $25, which is under variable. Remember, $25 variable cost per unit plus $10 fixed cost per unit. That's how we got to 35, right? You take your $35 per unit times 3,000 and then inventory equals 105,000. Sales minus total cost of goods sold, 420, equals gross profit of 180,000 minus selling and administrative expenses of 110. How we got 110? Well, remember, absorption costing, we take both fixed and variable cost together. 12,000 units that I sold times $5 of variable cost per unit plus 50,000 fixed costs equals 110. So 180,000 gross profit minus $110,000 of selling administrative expenses equals an operating income of 70,000. You all see the difference, right? Between variable and absorption costing? Makes sense, yeah? Best way, wonderful, thank you for the thumbs up. Yes, so the best way to remember is absorption costing means we take fixed and variable costs together. Whereas in variable costing, we're only taking the variable costs into consideration when we sell the product. Fixed costs are expensed. So there's a difference of 30,000. We saw that in absorption costing we had 70,000, and under variable costs we had 40,000. That gives us a difference of 30,000. Yeah, fun stuff. So that's when the units manufactured are greater than what we sold. Now let's look at it from the other perspective of when the units manufactured are less than what we sold. When it's less than what we sold, the variable cost in income from operations will be greater than absorption. So it's, in other words, it's the opposite, right? Let's assume that our company had the following: a beginning inventory of 5,000 units. We manufactured an additional 10,000 units during the period. We sold 15,000 units at $50 per unit. A lot of the information is the same, just like it was before. We started the month with 5,000 units. My manufacturing cost variable was 125,000. My at $25 per unit variable. My fixed cost per unit was $10 per unit. 5,000 units beginning of the month I already had available. 5,000 units times 10 is 50,000 for fixed cost, manufacturing costs. You add together your variable and fixed manufacturing costs to get total manufacturing costs of 175,000. That's just for the beginning inventory. Okay. Then during the period, we manufactured an additional 10,000 units. And we do just like we did before. We take our 10,000 units manufactured times the variable cost per unit, in this case $25 per unit. $25 times 10,000 is 250,000 variable cost, manufacturing costs. Then we have fixed costs. The fixed costs for this are actually a little bit higher than it was at the beginning of the accounting period. Fixed costs for the units manufactured are $15 per unit, so it's a little bit higher. It's higher by $5. Why did it go up? I don't know. There's probably an increase in selling administrative expense. No. There's an increase in fixed wages. So $15 per unit times the 10,000, 150,000. Variable manufacturing cost plus fixed manufacturing cost for the period equal 400,000. This example. Then we have selling administrative expenses. $5 per unit. We sold 15,000 units. 5 times 15, 75,000 variable cost. We have an additional fixed selling administrative expenses of 50,000. There is a total selling administrative expenses of 125,000. Now let's look at the difference again between absorption and variable costing. Under absorption costing, remember absorption, we have fixed and variable cost together. Sales, we sold 15,000 units, $50 per unit, 750,000. Cost of goods sold. When we consider cost of goods sold, we need to break out beginning inventory and cost of goods manufactured. We consider these to be separate because the cost of manufacturing, especially in this case, is different per unit than at the beginning of the accounting period. At the beginning inventory, I had $35 per unit, and I started with 5,000 units. It's 175,000. I manufactured an additional 10,000 units during the month. 10,000 at $40 per unit. It's 400,000. You add your two cost of goods, the beginning inventory and your cost of goods manufactured together, you get total cost of goods sold, 575,000. Sales minus cost of goods sold equals gross profit, 175,000, minus selling and administrative expenses, 125. How 125? 75,000 of variable selling administrative expenses plus 50,000 of fixed selling administrative expenses. 175,000 minus your total selling administrative expenses of 125,000 equals operating income of 50,000. So that's absorption costing. Now take a look at variable costing. Now remember, in this example, we sold more than we manufactured. So sales, 750,000. Now remember, in variable costing, we separate variable from fixed. Variable cost of goods sold. Variable beginning inventory, $25 per unit of variable cost times the 5,000 units we started with, that's 125,000. Variable cost of goods manufactured. Remember, variable cost, $25 per unit. We manufactured 10,000 units, that's 250. You add the two together to get to total variable cost of goods sold, 375,000. 750 minus total variable cost of goods sold equals your manufacturing margin of 375,000 minus your variable selling and administrative expenses. This variable was $5 per unit times 15,000 units sold equals 75,000. Total manufacturing margin minus your total variable selling administrative expenses equals contribution margin of 300,000 minus your fixed costs. So fixed manufacturing costs were 150,000 and fixed selling administrative expenses was 50,000. So 150 plus 50 is 200,000. You take your contribution margin minus your total fixed costs equals operating income of 100,000. You see that in this example, because we sold more inventory than we have manufactured, that the variable costing method yields a higher operating income than it would under absorption cost. Does it make sense? Are there any questions so far?
Professor, I got a question. It makes
Or Andre, sorry.
I'm taking the time to kind of like soak in information at a time, but for as far this particular problem reminded me of like one of the homeworks that I was working on for number 5 of homework
Yes,
20.
that's right.
Um, I was just wondering if is it possible that uh, we can just go over that if there's time to make sure.
I'm going to caution and say no, and the reason being is because I'm still actually waiting for a few of your classmates to submit. So because of that, I'm not going to go over it in today's presentation. But Andre, if you'd like, let's you and I either set up a separate time or we'll communicate through email, and I'll be happy to walk you through that.
Thank you, Professor.
My pleasure. Absolutely, yeah. Yeah, again, the only reason why I can't do it today is because there's still a few of your classmates that haven't submitted yet. Don't want to give away too many secrets.
It'll be helpful in that time.
Yes, absolutely, absolutely. Very good. All right. So this led to a difference of 50,000 between the absorption costing and the variable costing method. So the best way to think about it is if the units manufactured equal the units sold, then there's no change in inventory. If the units manufactured equal the units sold, then the absorption costing will be the same as the variable costing. The two will equal. If the units manufactured are greater than the number of units sold, we'll have an increase in our total inventory, and the absorption costing will be greater than the variable costing. Of course, the opposite is true. If the units manufactured are less than the units sold, then we'll have a decrease in total inventory, and the absorption costing will be less than the variable costing. That's the total effect. So again, the idea behind it is to remember that absorption costing, we are inclusive of both variable and fixed costs together. Under variable costing, we separate out the variable costs into cost of goods manufactured, and the fixed costs are separate. There's ways to think about it. Okay, let's analyze the information, shall we? So when units manufactured are greater than units sold, the finished goods inventory will increase, obviously, right? If I make more than I sell, I'm going to increase my total finished goods inventory. Under absorption costing, a portion of the increase is related to the allocation of fixed manufacturing overhead to ending inventory. So as a result, increase or decrease from income operations due to the change in inventory levels. What do? We analyze the operating income where increases or decreases in operating income could be misinterpreted as operating efficiencies or inefficiencies. In other words, as a manager, when I look at a change in my finished goods inventory level, I automatically think about potential efficiencies or inefficiencies in the business. For example, if I don't want to use, do I want to use Bed Bath & Beyond? They might be a perfect example of this. Oh, I'll use Sears. They're a great example of this. Okay, so most of us are probably familiar with the Sears department store that started in the early 1800s and are almost bankrupt today. They're still operating, but they're operating at a very different level. The company, oftentimes you'd walk into the store and there would be endless amounts of inventory on the shelves. And that can be perceived as being inefficient. Why? When there is a lot of inventory on the shelf, that's a lot of money that is tied up in inventory. Okay, that can be very detrimental to a business, especially a young business. Let's say you are a retailer and you have inventory that you sell. Let's say you sell on Etsy or Amazon or whatever, or you have a brick and mortar store. If you have a lot of inventory, you essentially spent a lot of money creating that inventory. A lot of direct materials, a lot of direct labor, a lot of factory overhead went into manufacturing those products. You have a lot sitting on your shelf. That means you have a lot of cash that you tied up in inventory. That is an inefficient way of running a business. Now, if there's an increase in finished goods, that can help you to identify a potential inefficiency. If there's a decrease in finished goods, that could be interpreted as being more efficient. It depends, right? It depends on perception, but a lot of it has to deal with knowing what is a safe amount to have in finished goods inventory. So a lot of what we do, especially in Principles of Accounting 2, is we talk about from a management perspective, in accounting. And so that's why it's important that we understand those types of concepts. Let's look at it from another example. Let's assume that a frame manufacturing company has zero beginning inventory, and our sales are estimated to be 20,000 units at $75 per unit. We also assume that our sales will not change if more than 20,000 units are manufactured. Okay. The management of our company is looking at two proposals. Proposal 1. If we manufacture 20,000 units, or Proposal 2, should we manufacture 25,000 units? The costs and expenses related to each proposal are on the following. So remember, Proposal 1, we're going to manufacture 20,000 units. Proposal 2, we're going to manufacture 25,000 units. Here are the differences. 20,000 units, variable cost of $35 a piece. $35 a piece, 20,000 units is $700,000. Fixed cost per unit is $20 per piece. 20 times 20,000 is 400,000. Total variable and fixed costs for manufacturing is at 1.1 million. Okay. Selling administrative expenses, I have $5 variable selling administrative expenses, 20,000 units, it's 100,000. Fixed selling administrative expenses of 100,000, giving me a total selling administrative expenses of 200,000. Okay, there's a little asterisk here at the bottom. We see that the fixed cost per unit, how did we figure out what the fixed cost per unit is? If you ever need to figure out what is the fixed cost per unit, you take the total fixed cost divided by the number of units. That gets you the total fixed cost per unit. Okay, so that's Proposal 1. Now let's look at Proposal 2. Sorry about the color. I know it's a little bright. Proposal 2, 25,000 units, and we're still gonna sell 20,000. So think of it this way: Proposal 2, we're kind of giving ourselves a little bit of room to work with. Yep. Variable cost 875,000. Variable cost $35 per unit times 25. Fixed cost 400,000. Gets that my total fixed cost per unit is $16. It's a little bit less. You're saying, well, Dr. B, how's that possible? Remember, fixed cost remains the same regardless of the level of output. So if my fixed cost is 400,000 divided by 25,000 units instead of the 25,000 units, 5,000 units more, equals $16 per unit of fixed cost. The total cost divided by the number of units. My total manufacturing cost is 1.275, 1,275,000. My variable selling expenses are the same because remember, I'm only selling 20,000 units. And my fixed costs are, of course, going to be the same regardless of the level of output. Total selling administrative expenses is 200,000. Now, if we run it out through absorption costing and variable costing. Under absorption costing, sales are going to be the same. Because remember, I'm only selling 20,000 units. Cost of goods sold is going to be slightly different. The reason why, again, is the fixed costs remain the same. And remember, absorption costing includes both variable plus fixed. Variable plus fixed. You can see that my cost of goods sold for proposal 1 is 1.1 million. For proposal 2, it's 1.275. The other difference here is I have an ending inventory balance. Remember, in proposal 2, I manufactured 25. Proposal 1, I manufactured 20 and sold 20. So 5,000 units ending inventory at $51 per unit cost of goods manufactured equals 225,000 ending inventory. My total cost of goods sold, 1.1 million for proposal 1, 1,020,000 for proposal 2. Take cost of goods sold, sales minus cost of goods sold equals gross profit. 400,000 proposal 1, 480,000 proposal 2. Selling administrative expenses didn't change. 100,000 variable, 100,000 fixed, 200,000. 400 minus 200 is 200. 480 minus 200 is 280. So out of the two proposals, in this case, as a manager, I would probably lean toward proposal 2 because we can see that gross profit is higher in proposal 2 by 80,000. But that's under absorption costing. What if the company is using variable costing? So let's take a look. So yeah, 80,000 in option 2. But if the company is using variable costing, it's going to be different. Under variable costing, the operating income is 200,000 regardless of whether we made 20,000 or 20,000 or 25,000 units. This is because no fixed costs are allocated in the units manufactured. So they're expensed out, just like we learned earlier. So, having said that, it's important to understand the differences between the absorption and variable costing. So let's look at it, right? So we can see that under variable costing, if I made 20,000 units or 25,000 units or even 30,000 units, my operating income is going to be the same. Okay, it's going to be the same. Why is it the same? Because remember, fixed costs do not change with the level of output. They remain the same. But what does change here, as you can see, is the variable cost of goods manufactured. We know the variable cost of goods manufactured, $35 per unit, times the number of units. So as that changes, we know that the level of units will change based on the level of sales. So interesting, very interesting. So as we use absorption and variable costing, they help us as managers to make decisions based off of our costs. They also help us to price our products properly. Under absorption and variable costing, it also helps me to plan for production and to analyze market segments. In these decisions, absorption and variable costing, very important as we make decisions based off of these items. As we saw in our earlier example, with this example, the difference between 5,000 units, manufacturing an additional 5,000 units, I can see I make the additional 5,000 units under absorption costing, my gross profit's 80,000 higher. Okay, but under variable costing, we know it's going to be different. So it won't be different in terms of income, but the way that we identify the variable cost is what makes the big difference. So as a manager, that type of information is very helpful when it comes to controlling cost, pricing products, planning for production, and analyzing market segments. Let's talk about those. Absorption and variable costing in accounting reports helps management to make decisions based off of controlling costs, pricing products, production planning, and market segments. Controlling costs. As you know, controlling costs is a very important aspect of business. They help us to identify costs that become out of control based off of explaining. As and I think I told you all the story. I used to be a financial controller. And in my job as a financial controller, I was responsible for controlling costs. How did I do that? I helped identify revenue and expenses based off of trends and make sure that they did not get out of line with those trends. All costs are controllable in the long run. Sometimes short term, that's not always the case. We know that. But in the long run, they're controlled. However, not all costs can be controllable at the same level of management. For example, at the employee level, at the frontline level, they may not have the same ability to control costs as the supervisor would. The supervisor may not have the same ability to control costs because of the level of organization. A supervisor that's responsible for the assembly department won't be able to control costs in the fabrication department, right? Because they don't manage that department. And in some cases, we cannot control costs over things like insurance related to the property, plant, and equipment. Sometimes there is no controlling that cost. Costs that are controllable are said to be costs that can be influenced by management. Costs that are not controllable are said to be costs that another level of management would control. Variable manufacturing costs are controlled by the operations. And we know that because the operations management controls the direct materials, direct labor, factory overhead that goes into the manufacturing process. Manufacturing process is part of operations management of the business. Manufacturing overhead, such as salaries of production supervisors, those are normally controlled at other levels of management, not at the operations. I'm sure they would like to, but I'm sure that operations managers would like to set their own salaries, but we know that's not possible. Fixed costs and expenses are reported separately under variable costing. Variable cost reports are normally more useful than absorption costing because of that. Pricing products, another management level decision based off of absorption and variable costing, because pricing products is how we identify things like margin. In the short run, fixed costs cannot be avoided, so we need to change the selling price in order to cover our fixed costs. Any sales price at a minimum must cover its fixed costs to generate an income. You need to cover at minimum your fixed costs in order to generate an income. Otherwise, it's called a loss. We don't like to sell things at a loss. Nobody wants to lose money. Since variable costing reports variable and fixed costs and expenses separately, it's typically more useful than absorption cost reports are. That's why I personally like variable costing reports more than absorption costing reports. Because with variable costing, we're able to break out variable and fixed costs. Having seen them separately, it's more useful. The information is more useful. So we need to set our prices high enough to cover all of our costs and expenses. So we set our prices higher than variable and fixed expenses in order to generate an income. Otherwise, it's a loss. Absorption costing includes fixed and variable costs, and therefore it's useful to identify the absorption costing method when we set prices. So let's break pricing products down this way. I would look at the absorption costing method to help me to identify the sales price. But I would use the variable costing method when it comes to controlling the sales price. Right? So they both have their benefits. What about production? As we talked about before, it's really important that in a production setting, we plan for production. We don't do anything in business without a plan. Okay? A plan is how we run. A plan gives us order. A plan gives us control. So in the planning process, we look at the absorption and variable costing from the perspective of giving us the relevancy in manufacturing in a short run. Okay, in a short run. If revenues from a purchase order exceed the related variable costs, the order will increase to the contribution margin, which will ultimately increase to the operating income. Here's how to think about it. When my sales exceed all the variable costs, of course it's going to increase my contribution margin. And that's the key point. That's why it's important to look at the variable cost method when it comes to planning for production. Since variable cost reports the contribution margin, is very useful. It's more useful than the absorption costing method when it comes to planning for production. In the long run, it's important to look at absorption costing because it considers fixed and variable costs together. So short run, variable costing, definitely. Long run, absorption costing when it comes to production. And of course, analyzing market segments. You hopefully learned about this in your Introduction to Business course. If you haven't yet, there's going to be some information ahead of time. So a market segment is a portion of the company that can be analyzed using sales, costs, and expenses to determine its profitability. Examples of a market segment would be things like sales territories, product line items, salespeople, and customers. These are all considered to be market segments for the company. When absorption costing, when we use absorption costing in market segments, we look at the long-term analysis of the market segment. For absorption, long-term. For variable costing, it's short-term. Most companies prepare variable costing reports for each product. This information is useful when identifying product pricing and whether we should discontinue a product. Variable costing reports are prepared for geographic areas, customers, distribution channels, salespeople, or other market segments. Distribution channel is what we call a method for selling the product to a customer. That's a method of distribution. How do we get the product to the customer? That's what distribution is. Hopefully you learned about that already in your intro to business course. If you haven't, then you learned something. Here's an example. Let's say we have a fragrance company. Oh yeah, well, that sounds nice. Fragrance company. I should say that smells nice, right? Fragrance company. They make perfume and cologne. The company's data for the month of March. We have a northern territory and a southern territory. So north and south. We have two products that we sell. The first one is perfume for women. The second one is cologne for men. In the north, we sold more perfume than we sold cologne. In the south, we sold more cologne than we sold perfume. You can see it, the sales for each at the top. The variable production cost for the perfume is 12% of sales and 12% of sales for the cologne. So just it's an interesting way of analyzing the market segment by market segment. We have promotion costs. Promotion costs are, think of it as advertising. The word promotion in accounting is the same as advertising. Promotion is advertising. And then you have sales commissions. By looking at sales territories, which is a part of market segments, it helps us to identify profitability for each item in each sales territory. And here is a report that you might see when it comes to the territories. So you got your sales minus variable cost of goods sold equals contribution margin minus your variable selling expenses equals contribution margin. And what then we at the bottom you see this thing called contribution margin ratio. Contribution margin ratio. What is contribution margin ratio? We take the contribution margin divided by sales. Contribution margin divided by sales is the contribution margin ratio. These ratios are very important for managers to understand because it helps us to identify the respective amount of contribution each product provides to the company. Here's another term for you. It's called sales mix. Sales mix is referred to as the product mix. Hopefully you learned about this in your intro to business class. If you haven't, it's another great term. Sales mix is also called product mix. It's the relative amount of sales across various products. Sales mix is computed by taking the sales of each product divided by the total sales in each territory. That gives you your sales mix. It's a percentage. So sales mix as a ratio or percentage, we take sales of each product divided by the total sales in each territory. It's your sales mix. Profitability. It's very important that companies focus on how profitable each of their products are to the business. We've got to make sure we make a profit. So what do? What is profitability? Remember, I talked about the thing called margin. Margin is profitability. Margin is profitability. Sales minus variable cost of goods sold equals manufacturing margin minus variable selling variable selling expenses equals contribution margin. Contribution margin ratio. Contribution margin ratio taken by taking your contribution margin divided by sales. In our example, the company, the perfume's higher contribution margin ratio is a result of lower promotion and sales commission costs. So management should consider looking at marketing plans for the cologne, for the perfume. Promotion and sales commission costs are too high. Reduce them a little bit and increase the price for the perfume. These are some examples that we can conclude just by looking off of that data. Cool, right? I think so. I think it's cool. Another market, another, what did I call it before? Another segment of market segment is by looking at salespeople within each salesperson. To determine whether a salesperson is, efficient. We're looking at a salesperson's efficiency. We look at their total sales, variable cost of goods sold, variable selling administrative expenses, contribution margin, and their contribution margin ratio for each salesperson. Basically, it's the same approach as we took for the sales territories. We did the same exact thing for salespeople. And that's what this slide shows us here. We take the same approach for salespeople, right? Sales minus variable cost of goods sold equals the manufacturing margin minus variable selling expenses equals total contribution margin. Contribution margin ratio is calculated by taking the contribution margin divided by sales. and the sales mix. Sales mix. Okay. Profitability analysis. Is our salespeople working well for us? By looking at profitability analysis, we look at things like their sales growth rate, years of experience, customer service, territory size, and actual performance compared to the budgeted performance. Remember, actual compared to budget. Those are great benchmarks for a business to determine whether the business is successful. Okay, we're almost done. Reporting income using variable costing for service businesses. Remember, a service business is a business that does not sell products. A service business is one that does not sell products. Instead, the service business is one that has patients, clients, or they sell another service. Service businesses do not carry inventory, so they do not use absorption costs, but they could use variable cost method. So in this example, we have an airline. An airline is a service. We use a variable costing method. In our airline, we have fixed and variable expenses, but we use the variable costing method for reporting. Depreciation expense is fixed cost, $3.6 million. Food and beverage service expense, $444,000, variable. It's variable because we purchase different food and beverage amounts based off of the number of passengers. Fuel expense, $4,880,000. That's a variable expense. It's based off of the number of miles flown. We have a rental expense of $800,000. Probably a bunch of copiers and computers and stuff. Selling expenses, $3,256,000. It's variable. It's based off of the number of passengers. And wage expenses, also variable, $6,120,000, based off of the number of miles flown. Costs are classified as either fixed or variable, based off of the level of output, based on the activity base. In manufacturing, then it's based off of the number of units produced. But in a service business, it's usually based off of the activity base. We learned a lot about that when we talked about activity-based costing, remember? So looking at our airline for the month of April, our total revenue was $19,238,000 for the month of April. Variable costs, we had a fuel expense of $4,080,000, wage expense of $6,120,000, food and beverage expense of $444,000, selling expenses of $3,256,000. Our total variable costs were $13,900,000. So we take our revenue minus our total variable costs equals our contribution margin of $5,338,000 minus our fixed costs of $4.4 million equals an operating income of $938,000. That was fun. So that's a service company. But you see, with a service company, we can still use the variable costing method for service companies. Cool. And of course, to analyze the segments using the variable costing method for a service company, we look at the contribution margin, we analyze it, evaluate it to help us to inform our market segments. A couple of examples of service industries and their market segments. Electric is based off of regions and customer types, industrial or consumer. Industrial is another word for business. Banking, based off of customer types, commercial, retail, and their products that they sell, loans, savings accounts. Airlines, their products are passengers and cargo, and the routes that they serve. Railroads, they service commodities and they have different routes. Hotels, those are the hotel properties. Telecommunications, commercial or retail, voice or data. Healthcare, procedures, payment types. Some idea. These are markets and their related segments. This is examples from our airline. And based off of market segments, in this case, routes. Here's an example. Okay, I want to talk about this one thing called EBITDA. EBITDA. That's a term. Earnings before interest, taxes, dividends. EBITDA. Earnings before interest, taxes, and dividends. Amazon, here's an example, reports 3 different segments on their 10K report. They have sales, operating income, and depreciation expenses disclosed on their financial statements in the notes. Just an example, this is all in millions, so take whatever it is, multiply it by a million. Segment operations income, depreciation expense. Basically what this information tells us is the company's ratios, just like what we talked about before. EBITDA. Operating income is usually expressed by adding back in depreciation and amortization expenses. Oftentimes, company will use their EBITDA, EBITDA. This is the amount before interest, taxes, depreciation, and amortization. EBITDA removes a significant fixed and non-cash cost from operating income, maybe appropriate for contribution margin. Usually, with a publicly traded company, we use the earnings before interest, taxes, depreciation, and amortization to identify the company's contribution margin. It's basically a substitute for contribution margin. Don't worry, it won't be. You won't really see this much. That's why we're going through it a little bit quicker. And we made it! Yay! Okay. Comments, questions, concerns, as we just went over the chapter for variable costs and absorption costs.
Professor, it's a lot of information.
Go ahead, Andre. I'm sorry.
Yes, I'm saying it's a lot of information to digest, but I'm trying to conceive the concept or understand the concept rather of EBITDA.
Yeah, it's earnings before interest, taxes, depreciation, and amortization. So, if you look at an income statement of a publicly traded company, toward the bottom, where operating income is, you'll see it'll say earnings before interest and taxes. And we take the interest before interest and taxes and we subtract out the depreciation and the amortization. You get both of those from your balance sheet, of course. And as we subtract those two out, it gives us with what would normally be the contribution margin. Contribution margin is not a line item you will find on the income statement. It's not a line item. It is a calculation that you would make it as a manager or an investor. You would look at a company's contribution margin and divide that by sales to get the contribution margin ratio. The best way to think of it, Andre, is EBITDA is a substitution for the contribution margin. It's an alternative to the contribution margin.
So, Professor, is saying EBITDA saying it's like a substitution of the contribution margin. Does that include everything of EBITDA to be included in the contribution margin? Because I remember you was talking about, I think it was the E and T subtracted by
Yeah,
DA.
that's right. Yeah, so yeah, it does take in all those into consideration because we take the earnings before interest and taxes line item found in the income statement, and we subtract out depreciation and amortization. That gets us to that contribution margin. So it's basically another way of calculating contribution margin, essentially, but it's it's effective when we look at it from an investment perspective.
Okay, Professor. So I understand that when you subtract the ET from DA, but what about BI?
What about I'm sorry, but what about what?
When you subtract the ET from DA in order to equal the contribution margin,
Hmm.
how does BI the well, how does BI come into play?
BI. Oh, that's earnings before interest and taxes. Earnings before interest and taxes. It's a line item on the income statement.
All right, I just had a big explosion in my forehead. I understand now.
That's
Appreciate it.
okay. Yeah, so EBIT is all one thing. That's earnings before interest and taxes. And that's going to be a line item on the income statement. So when you look at an income statement, toward the bottom, you'll see these two things called interest and taxes. And just before that, you'll see this line item called earnings before interest and taxes. And then the DA is depreciation and amortization. Yeah, it's complex. Yeah, I know. The good news is after this, you probably won't see it again. Unless you're planning on investing.
Thank you, Professor. I really appreciate it.
My pleasure. Absolutely. Good question. Are there any other comments, questions, concerns on absorption cost or variable cost? Are we good? Everyone's feeling good?
We're good.
We're good? All right. Thank you, Angela. I appreciate that. Okay, so what does that tell us? Where are we? We are, what is it, week 7, right? We're in week 7. So, week 7, oh my goodness, there's me. Okay, week 7, in the classroom, week 7. This week, what do we have going on? We have a discussion board. Discussion board is your homework. Now, please, please, I know I talked about this before, I'm going to talk about it again. With discussion boards, what am I looking for? One original post, about 100, 150 words, original post. You're answering the question, okay? You're answering the question, but in a thoughtful way, yeah? You're looking at the book, you're answering this question, you're talking about it. It's a discussion, yeah? There's not a right or wrong answer. What is the purpose of a cash budget, right? You can talk about the uses of cash. You know what the statement of cash flows look like. You got operating income. You got you got your operating expense, your operating cash flows. You have your investing cash flows and your financing cash flows, right? You could talk about it from that perspective. You could talk about it from the perspective of, oh, I need this much cash to make these kinds of purchases, whatever. Uh, and then so you talk about the purpose of budgeting for cash, right? Or identifying a cash budget. And then you can talk about it from a quarterly perspective. If the cash is for the first quarter of a fiscal year, what do we do about the ending cash flow from the previous year? What do we do about for the first 2 months? This will require you to read the chapter. You could also do some outside research. Feel free to use outside sources. Okay, just make sure you cite them. Citations, references, full paragraphs. Okay, 150 words each. Yeah. So one original post. I want you to try to have this done by Thursday night. By Thursday night. The reason why Thursday night is so it'll give you enough time to respond to 2 or more of your classmates with additional full paragraphs. Okay? So what are we looking for in total? By Sunday night, you should have 3 separate posts, 1 original post, 2 responses to 2 of your classmates. That's 3 total posts. Okay? With at least a paragraph in each post. Try to use citations. Try to use references. Try to be creative. Okay? It's a discussion. Discussion means a conversation between 2 or more people. Okay? Not just you posting and that's it. No. That's not a discussion. How is it graded? There is a button right here that says a grading rubric. Here's how it's graded: comprehension, timeliness, engagement, writing mechanics. Take a look at this rubric. You want to try to be in the excellent category. How is it excellent? Make sure they're full paragraphs. Make sure they're thoughtful. They are inclusive of details. Yeah, they're on time. They provide relevance. And you're interacting with 2 or more people. And we have good punctuation, stuff like that, right? Citations, references, if you can. There's a tool I recommend you use called Grammarly. 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 Okay? Grammarly. Wonderful, wonderful. It's free. In fact, not only is it free, UDC also purchased this for you. Okay, UDC purchased this for you. What do you mean, Dr. B? Go to Grammarly.com and use your UDC credentials to log in. When you set up the account, use your UDC credentials. You'll get the premium version of Grammarly. What does it do? It checks your grammar. It also gives you recommendations for replacement of your grammar. It also checks your spelling, punctuation, grammar, all of those great things. It's way better than just using Microsoft Word. It goes above that. So for those of you who are going to be doing a lot of writing throughout your degree program, for those of you going on for your bachelor's, for those of you going on to your master's, highly, highly recommend you get Grammarly. It's free. UDC already paid for it, so use your credentials. Grammarly.com. Set up your free account through using your UDC credentials and use it. Okay, download it to your device. They even have extensions for your web browser. They have extensions for Microsoft Word. It's super helpful. I promise it's super helpful. You'll love it. So just use it. It's free. Besides, UDC paid for it already. So do it. I promise it'll help. It's a great tool. What I recommend you do, type it in Microsoft Word and then paste it into the discussions forum. That way it'll check it, right? Any questions on that? What do you say?
No, sir.
Great.
Thank you for that info, because I surely wasn't gonna pay for it.
Hey, no, don't be paying for nothing, Lakeisha. Come on now.
Oh no, I wasn't gonna pay for it. I'm just saying thank you that they have it. That's good, because then I can further use it.
Yep, absolutely. Yeah. Grammarly.com. Use your UDC credentials as you access it. And
Another tip, if you didn't know, if when you download Grammarly, you can actually, if you type stuff up in Word, you can do an add-in, and
yes,
it'll automatically, do everything for you inside of the Microsoft Word document.
exactly, and that's a great add-on. So I'll open this document. I have this document open. This is an assignment I'm working on. There's the buttons up here, and it'll show up in your ribbon. It says Open Grammarly. I open that up. Of course, it's not going to do it because I want to show you guys how it works. There it is. Stop a little slow. So I opened Grammarly up, and you see how it just underlined a lot of different things, right? And what does it says? If you click on that underline, or you click over here to the right, it says add a comma. So in our case, there will be a comma after the word case. And to put it in, just click on it, click change. It's super easy. Oh my goodness, it's a wonderful thing. Like etc., etc. There should be a period after that. So you click, and there's the period. Oh my goodness, so cool. And then there's other ones that they're in green. These ones in green, they give you recommendations to vary your words. Very, very cool. So yes, please get the Grammarly. It's free. The university paid for it. Use your UC credentials to access it. As you're going forward with your degree program, I know you all will be writing reports and doing research and all that fun stuff for your other courses. That's why I think this would be a great tool for you to have in your arsenal as you move forward. So please get it if you don't already. Super, super easy. And it's a great tool. So thank you, Thidron, for adding on to that. That was very good. Okay, so what we have by Sunday night: 3 posts, 1 original, 2 responses, full paragraphs, citations, references, all that good stuff. Feel free to use outside sources. Use Grammarly. Yeah, it's due by the 28th. That's this coming Sunday. Okay, then next week we do not have a WebEx session. You will have the final, I'm sorry, not the midterm. Oh my God, I'm trying to rush it. The midterm exam next week. That'll be due by next Sunday. Open book, open note. I recommend it covers weeks 1 through 7. So everything we started with the semester all the way through week 7, chapter 21. It's 10 questions. With 10%.
Well, 2 weeks from now.
Go ahead, Thidron.
No, 2 weeks from now.
2 weeks from now. Yes, that's right. Yep, 2 weeks from now. So after this week is done, the following week you have the midterm. It's due by the 7th of March. It's already open. It's available. Make sure you finish it by the 7th of March. After that, week 9, guess what? Spring break! Yay! Week 9, spring break. No class, spring break. So I won't see you all until like 2 weeks from now. Right? So, in the meanwhile, please feel free to email, call, set up office hours, all of that great stuff. I am here for
So,
you.
Professor, I just want to be clear. So you're saying next Monday is no class with you?
That's right. What next Monday? No
Okay.
class. Take your midterm. It's midterm week. Midterm week. No class with me.
Got it. Thank you.
Some of your other professors might hold classes during midterm week. I don't. And the reason for that is because I want you all to do well on your midterm exams. It's important that you spend that time to focus and study. Absolutely. Okay. Any other comments, questions, concerns before we call it a night? All good. All right. Thank you again for a wonderful time together. I appreciate your commentary, your interactions throughout. It makes it fun. Okay. If you think of anything afterward, feel free to email me, call me, set up office hours with me. Whatever it takes, I am here for you 100% of the time. So thank you all so much, and I hope you all have a wonderful rest of your night. Stay safe, wash your hands, do the right thing. Thank you so much. Take care.
Thank you.
Thank you, Professor. Have a good
Good night,
evening.
Thank
everybody.
you too. Good
Good
night,
night,
everyone.
Professor.
Take
Thank you,
care.
Professor. Really appreciate this.
Hey, my pleasure. My pleasure. Take care, y'all. Good night. Good night. Good night. Good night. Good night.